Let's bring you more of that breaking economic data out of Singapore this hour. The country's Trade and Industry Ministry upgrading its GDP growth forecast for the year to around 4% from between 1.5 and 2.5%, which was projected earlier. Now, this upgrade is on account of a better than expected performance in the third quarter. GDP for the quarter ended September grew 4.2% on year. That is a much stronger pace than early estimates of 2.9%. That also beats economists' forecast for a 4% growth, although it marked a slowdown from a revised 4.7% expansion in the second quarter. Now, data from the Trade and Industry Ministry show growth in the quarter was driven mainly by the manufacturing wholesale trade as well as the finance and insurance sectors. Growth in the manufacturing segment that was led by the electronics, transport and engineering, as well as biomedical manufacturing clusters. NMTI has upgraded its growth forecast for Singapore's economy for 2025 to around 4%, as we talked about earlier. Authorities said global economic conditions turned out to be more resilient than earlier thought. Well, Singapore's key exports in the third quarter were weighed down by the decline in non-electronics, particularly due to weak shipments of food preparations, petrochemicals and pharmaceuticals. But the government is expecting strong AI-related demand and high gold prices to support the city-state's trade performance in Q4. And for this year, authorities have narrowed their NODX growth forecast to around 2.5%. They project export gains moderating further in 2026, citing risks such as a potential renewed escalation of tariff actions that could weigh on demand. And for a closer look, we are joined by Selena Ling, Chief Economist and Head of Global Markets Research and Strategy at OCBC. Selena, thanks for your time today. So that Q3 GDP coming in 2.4 quarter on quarter, and then we've got the year-on-year figure coming in at 4.2%, also better than expected. Your reaction to the latest numbers, please.
Well, we were expecting the third quarter to be revised up to 4%, so it's slightly better than expected on a year-on-year basis. A lot of this was due to the huge upgrade in manufacturing because we got a very upside surprise for the September industrial production number. But on top of that, we also did see a slight revision upwards for the construction and services sector. So on the whole, very positive surprise because it's very broad-based growth. But to a certain extent, that's a little bit of water under the bridge. The question is, of course, how will fourth quarter perform? I think the upgrade of the official growth forecast to around 4% suggests that fourth quarter will slow a little bit, but it should still be around the 3% year-on-year handle.
Yeah, so that 4% is a pretty significant revision, upward revision. Talk to us about some of the factors that could help or hinder the economy from hitting that figure.
Well, we've come a long way. I mean, remember in May itself, after Liberation Day tariffs, there was a downgrade in the official growth forecast to 0 to 2%. We got the upgrade to 1.5 to 2.5 in August, and now we are at 4%. A lot of this has been due to the continued front loading of exports out to the US, but also the fact that the US economy has performed better than expected. And if you look across to the region, regional supply chains as well, China and ASEAN economies have also surprised to the upside for their third quarter performance. So net, actually, the global economy seems to be weathering the tariff storm better than expected. Of course, some of this could be due to the monetary policy easing that we have seen in recent months across the globe. Going forward, of course, the key question is whether the AI-related semiconductor demand will hold up. But on top of that, the wholesale trade and the finance and insurance outperformance in the third quarter. Wholesale trade also related to a lot of the AI and server-related type of demand for machinery and other types of relevant supplies. For finance and insurance, the outperformance really is because liquidity still remains ample. There's still quite a fair bit of wealth flows coming to the region. And on the whole, we think that this trend will probably continue. The key question, of course, is how many more rate cuts are we expecting from the Fed?
Yeah, Selena, a lot of these seem to be external factors. And so I wonder if, this revision that suggests a turning point in Singapore. Do you see it as a cyclical recovery in Singapore? Or, if it's just external factors, is it more of a one-off thing?
I think, of course, the external factor coming in better than expected did help a lot. That's one of the main reasons why manufacturing and also wholesale trade exceeded expectations for the 3 quarters of this year. But I think to a certain extent, there's a fair bit of domestic resilience as well. On the construction side, momentum has been very steady, and a lot of that, of course, has to do with the civil engineering works because of all the different type of infrastructure projects that is still quite apparent across the Singapore economy. But on top of that, if you look at the retail side and the inward kind of domestic consumption story, the irony is, of course, unemployment rate still low. There is still, wage increments. But on the whole, because Singaporeans are also still traveling a lot more, so there is some leakage to a certain extent, and the strong Sing dollar is facilitating that. But we also see that, my sector is doing well. So a lot of overseas business travelers are still coming to Singapore, as the recent FinTech Festival and also the F1 kind of attest to. So I think it's a little bit of a mixed bag for the services side. Not all the services sectors are, performing to the same extent. And I think this kind of very uneven growth for the services sector may actually persist into 2026. But 2026, because we're coming off from a very high base of around 4% growth in 2025, it will be quite prudent to look for some moderation. And I think the official forecast of 1 to 3% reflects that reality.
Yeah, I just want to go back to the point about AI that you brought up. So that is obviously supporting U.S. growth, global semiconductor demand. But how durable is this AI-driven cycle in your opinion? And is this region too reliant on AI-related semiconductor exports? And how much of a risk does this pose for perhaps the end of this year as well as next year?
Well, there are quite a few market skeptics out there about the whole AI story, as what we've seen in the recent volatility, in terms of the US AI-related stocks. I think some pullback is, of course, probably overdue, given that they've had such a big run-up this year. But I think in general, there's still a very big push, for AI adoption across the board. And for a lot of businesses, it's a matter of, partly it's a fear of missing out, but partly also because they are trying to reap some of the productivity gains from, adopting AI. So I think the huge investments and the capex that we see being invested into the AI global industry probably suggest that, it will still sustain for a while longer. But given that this is a very high growth industry, of course, it would be quite expected to see some speed bumps along the way and some pullbacks along the way. But in general, I think the order book seems to be quite strong. And of course, NVIDIA's guidance also appears to be looking for further growth, at least in the near future.
Yeah, and Selena, just the last one before we go. Given today's GDP reading, do you expect MAS to maintain its current policy stance at the next review?
Well, I think core inflation is coming down very nicely, to the 0.5% range that they have forecast for this year. And even though it's going to probably bottom and edge up a little bit, but between 0.5 to 1.5% forecast for next year is actually still within the official comfort zone. So I think there is no urgency for them to tweak monetary policy settings from here. In fact, we have seen that the trade-weighted Sing-Nier has actually pulled back from the extreme strong end of the band. So I think that actually gives them a little bit of leeway to continue to be on hold for the third consecutive policy meeting in January itself. They do have one more bullet left, which is to go to a flat slope. But given the outperformance in growth and given that the trade and the tariff situation seems to be stabilizing a little bit from what was initially feared in April, I think there is actually room to be on hold for now.
All right, Selena, appreciate your time today. Selena Ling, the Chief Economist and Head of Global Markets Research and Strategy at OCBC.